Good morning, everybody. Welcome to the session on securing your first or further round of funding. This session's really been put in place to support tech startups on securing funding and to support scale-ups in looking at how they more successfully secure first and second round funding. I've got an interesting panel of speakers with me today. I'm Sandy Finlay from ABGI. We are an innovation funding consultant working across 28 countries. And what I'd like to do now is just introduce each of the panelists and let them say a quick couple of minutes introduction of themselves. Why don't I start in the top left-hand corner? Ollie, would you like to introduce yourself and tell people a bit about Fuel Ventures?
Yeah, absolutely. So I am Oliver Hammond. I'm one of the investor directors at Fuel Ventures. Fuel Ventures is a seed stage fund. We're based in London, but geographically we invest all over the UK. We're an SEIS and EIS fund. So we have a fund that does SEIS tickets that go up to £150,000. We have an EIS fund, which is the fund that I represent. We do tickets of anywhere between £1 million and £3 million as part of our initial investment. We generally lead rounds. So we like to price rounds. We like to sit as the investor director. We like to to take a seat on the board. And we like to be very actively involved with our companies over a sort of a 12 to 18 month time frame until they raise their Series A, and usually beyond that as well. But generally at that point, we're not the primary investor. We invest into marketplaces, platforms, and SaaS model businesses, both B2B and B2C. And we currently have a portfolio of 50 companies that sit under our EIS portfolio.
That's good. Thank you. Anthony, would you like to introduce yourself?
Absolutely. Sandy, thank you very much. My name is Anthony. I'm leading the European part of the business at Seedrs. Seedrs is the largest in Europe currently equity marketplace and an equity crowdfunding platform. We are a sector agnostic investor. We have, until now, as a track record of done 1,500 rounds, about 1.8 billion euros or 1.5 billion pounds invested into startups through the platform. We've done investments across 21 different countries so far. And kind of my role is to support Europeans, non-UK founders, but obviously at the core of our business is in the UK. Yeah.
Good. Excellent. And Oscar.
Yes. So hi, everyone. And thank you, Sandy and Ollie, Anthony, for being here with you today. I work in the entrepreneur relations team of Angel Send Funding, which is an angel network or an angel platform, if you will, which essentially is quite straightforward. We connect great startups in the pre-seed and seed stage with high net worth individuals, sophisticated investors, and some institutional investors. So really what we try to do is to find the best startups and show them to our network and get them funded. Okay. So, yeah.
Good. Excellent. Guys, I'll make a start and hopefully Kazim will join us shortly. So I've got a number of questions that have been posed to us this morning. I've tried to identify the person I think most appropriate to lead on it. But what I would say is once we get into the discussion, please feel free for everybody to contribute because we'll all have opinions or views on these things. I think, Oscar, if you don't mind, I'd maybe like to start with you and just ask, given your role in Angel's Den, what type of companies or who, in terms of startup, is equity investment right for, and who is it wrong for? So where wouldn't you suggest or recommend equity investment?
I mean, there are a lot of different types of equity investments. I mean, you can talk about crowdfunding, angel investment, VCs, private equity, and so on. But from an angel perspective, which is my own experience, I can tell you which type of companies are not maybe ready for this. And first off, I think companies that are not very scalable or that you can't scale very quickly. If you can't build a company and really develop it and reach the types of revenues that an investor wants within a, let's say, 5 to 7 year period, then you'll have a fight with the investor. Then it will be difficult to explain to an investor why they should invest their money into your venture and not just I don't know, if you want 8% returns, you can go and invest in index funds, but you don't want that. You want 10, 20, 30 times returns or more. So it needs to be very scalable, and it needs to be a big market for that. Generally as well, a company without a product, let's say you have a great idea. A lot of people have great ideas. You might have a great team as well, if you're lucky, and if you're good. But the thing is, if you don't have a product that you can show, again, from my own experience, if you can't show the angels a product and some sort of initial validation that there is a demand for this product, it's going to be very tough for you to gather any interest. So having a big market, being able to scale, being able to have some sort of initial product to show. But then, of course, it can also be suboptimal on different level. If you look at, let's say that you can launch your business and then just fully sort of launch it just by your own bootstrapping, your business can be launched by that alone, and you might not need to seek equity investment in the beginning, or you might not need to seek it at all. Probably it can boost your development as a company, but it's not it's not something you need to do, so to speak, if you can do it on your own. But let's say if you need a lot of equity or a lot of money to get started, then it might be better to, let's say if you have built a prototype, but you also need the money to go to market and really start selling this and get it off the ground properly, then an equity investment might be more of interest. That's just some of the points. I can go on forever, but
no, that's good. Yeah. No, that's good, Oscar. Ollie, if I could maybe pick up with you on this. Oscar mentioned there, bootstrapping in the early days. Once you've got the prototype, if you've got that technology proven, that's going to be a good time for equity to come in. Investors often look for a blend of funding in an organization or in a company or a target. So what makes an attractive blend of funding? What is it you're looking for?
Okay, so when it comes to, again, so obviously when Oscar was speaking, he was talking very much from an angel point of view, understandable, obviously, because of the Angels Den connection, and I guess I'll speak from a VC point of view because that's really my background. So when you're talking about blends of funding, Sandy, do you mean in terms of, do I want to see a company that's raising debt and equity? And okay, fine. So when it comes to us and fundraising, generally when we invest in companies, the vast majority of companies that we invest into at the point that we invest, which is at seed stage, have generally only raised equity during their history. And the key reason for that is that we generally invest into non-profitable companies. There's not a lot of debt providers out there that would provide debt for non-profitable companies, because the big question on their mind is obviously, how is this going to be paid back? So the majority of companies that we will raise for, and I imagine probably the majority of companies that Anthony raises for as well, will be companies that have raised purely equity historically, and that's fine, because we as an investor are what I would generally refer to as a runway maker. So actually, I don't really care if the company's got 2-3 months runway left, because when I give them a ticket, I generally give them 12 to 18 months worth of runway when I give them that ticket. I've got the ability to do that because the tickets I write are big enough to do that, and that works well for me. When it comes to things like debt going into a round with someone like us just makes the whole thing a little bit more complicated. And the reason is because we're an EIS investor. Under EIS rules, you can't use EIS funds to repay debt. So when it then comes to managing that debt and repaying that debt, obviously with the monthly interest and things like that, it just makes the thing a little bit more complicated, and it's not something we're particularly interested in. We do actually have a couple of companies in our portfolio that post-raising have raised debt, and actually it's a sector that we're looking at quite a lot at the moment. We refer to it internally as the aggressive asset acquirer. We were a big investor into a company called Heroes around this time last year, which is an Amazon FBA business, very similar to Thrasio, which is the big story in the US. When Heroes approached us, they approached us on the basis that they were raising equity, and they were also raising debt alongside that. And in their seed round, which was the round that we led, this was a pre-revenue round. They raised about 10 million in equity and 40 million in debt. Which is very, very significant, right? That's not a normal story. That's a very, very outlier story. But the debt was a super important part of what they were doing, because the debt facilitates the acquisition of Amazon businesses, Amazon FBA businesses. So in a situation where we think that debt is suitable, mainly in an aggressive acquiring strategy like Heroes did, then we would generally happily invest alongside debt. The EIS funding would go towards company operations, it would go towards salaries, it would go towards all that stuff that the company can use the EIS funding for. The debt would cover the acquisition point. The majority of companies we invest into will just have raised equity, and at the point that we invest and post-investment will just be looking at equity as well. They generally won't have other forms of funding. In future rounds, they may look to do things like revenue finance, so through someone like Outfund or Uncapped. That's something we're generally relatively supportive of, because obviously it saves dilution. If they can raise a 15 million round with 10 million of equity and 5 million of revenue finance, then it saves us all from dilution. But that's something we generally see at a future point, as opposed to the point that we're investing.
Yeah, no, that's good, Ollie. I think it's maybe worth just pointing out that for a lot of early stage businesses, they need that equity to leverage grants, or if there's debt coming in, it's much easier once you've got strength in your balance sheet. And
they do.
Yeah.
You're absolutely right. They do. And I guess to cross over with Oscar's question a little bit in terms of what makes a round suitable, is that for an angel investor, the criteria that sits for angel investors and the criteria that sits for VC investors tend to be very different things. The return profiles tend to look very, very different. Mm-hmm. Angel investors, if you sort of look at Dragon's Den or something like that, that's that sort of style of investing. Generally, they'd be happy if they get in returns, significant returns. They're getting companies that are exiting at 30 to 50 million pre-money valuation, or 30 to 50 million valuation. Sorry, not pre-money valuations, because they're not raising. If they're exiting at that level, the angel investor has usually done very well, because they're usually coming in at a point where they're giving 100 to a couple of 100,000 at relatively low valuations. Our risk profile is very different. We don't really consider companies that we don't think can reach $1 billion in valuation. Like, that's just our criteria, right? Like, we're as a VC, we're heavily represented by our outliers, which means that every company that we invest into, we need to see the opportunity and possibility to be a unicorn business. And so when we look at businesses very differently. It doesn't mean that businesses that we pass on are bad businesses. In fact, a lot of them are good businesses. If you exit a business for 100 million and you own 80% of the business, and you've done very, very well, and no one can tell you otherwise, but they're just not the right businesses for us. Yeah. So that's where the angel equity versus the VC equity, that's where the big change is, and that's where the big difference is.
Yeah.
Can I add to this a little bit, just to add a little perspective here? Just loved what you guys have said, and I would love to kind of put this, absolutely agree with all the points. Just want to put this a little bit into kind of a perspective for the founders, maybe, because we have heard kind of the point of view of early stage VC. We have heard the point of view of business angel approach, so to say. So I tend to we at Seeders generally, we tend to look at the startup. We're looking now at startups. Now we're not talking about the lifestyle businesses. We're looking at startups that want to scale, that have the tech to scale, they have the business model that is scalable. If we look at the fundraising options for them, if you kind of start your fundraising journey here and end it here somewhere, where on this line, so to say, that would be the exit, IPO, whatever you want, and here you start. Traditionally, the standard way for raising in the beginning, at least here, and all this part until here, would be equity for startups that want to scale. So you would probably start with kind of raising money from friends and family, from your first business angels, maybe going to Oscar here to get your first money in there, then going further on somewhere to maybe something like equity crowdfunding or early stage VC. As you scale, as you get in your first revenues in, you go into later stage VCs, maybe family office here coming in, but then you also the first time where you actually become eligible to raise some additional debt, because you start getting your first revenues in. This is kind of the stage where debt financing is becoming actually possible pretty much for a startup as it is, because before that, it didn't have any track record. The company did not turn over any money there in order to be able to get that loan in. And then pretty much the further you go, the further it extends. And this is just wanted to kind of put this all on a timeline, on a maybe life cycle model, if you want, where the company is in what stage certain funding options, so to say, become available, make more sense depending on where you are.
Yeah, no, that's good. A good point, Anthony. Just moving on from that, though, it's worthwhile saying, I think, picking up on Ollie's point and Oscar's, there are different types of equity there, or equity investing. It's really important that the companies are matching their needs with the investor's own investment profile. Ollie, I think that, you know, you're looking for a different exit point from Oscar's company, so that's good. Anthony, if I could just move on to you, and when companies share their pitch deck with you, what are the factors that convince you want to take it further? You know, what are you looking for in that deck? What are the key points? Oscar mentioned earlier about, you know, a clear product and indicators of scalability. What are the things that excite you?
Sure. I would love to answer this from kind of two perspectives. The first perspective is it's kind of generally looking at pitch decks. I think this would be maybe helpful advice for startups, especially kind of earlier stage stuff for startups. There are definitely different types of pitch decks that are out there. For me, at least, there are at least two types of decks that are there. There's a deck that you send to investors. There's a deck that you present. So do not confuse them. First of all, those are different things. And those are kind of, let's talk about the deck that you send out to investor as a handout. When investor gets it, reads through it himself or herself without you presenting. This should be a very different deck, or not a very different deck. This should be structured in a different way compared to the deck that you're presenting. That's the first thing I want to say. The second thing I want to say is kind of from the seeders perspective here. So I want to bring in our perspective this time. So we are equity crowdfunding platform. We help companies raise from retail investors, not professional investors. Again, at a different stage from pretty much pre-seed up to Series B. But when we look at the decks for the companies, we look at two types of criteria, two groups of criteria. The first group of criteria would be investment criteria. They're pretty much not very different to what Oliver or Oscar would be looking at. Those things would be, we would be looking at the, depending again on the stage of the business, we're looking at the team, for example, if it's an early stage business, we'll be looking at the traction, total addressable market, the technology, and all those little things that this investor would look at in a good business that will bring returns and come to an exit in the future. Those are the one thing. The second thing, which will be, I guess, different to what other colleagues of mine look for, we would look at the crowdfunding criteria. Because obviously, if a company wants to raise from retail investor, that has to have the proposition to kind of be likable, so to say, to be able to raise a very complex B2B product with a very complex technology, will have a lot more difficulties raising from retail investors compared to a fintech B2C product, which is really understandable and easy to use and everybody's using. So when we're looking at the crowdfunding criteria, we're looking at pretty much kind of, does the company has a community? What's the value add of the raise beyond the capital? Do they want to do the marketing? Is this a consumer acquisition exercise? And what's the size of their network already that exists that we are able to tap into together? And the last thing, again, how understandable is this to our community, to our investors on the platform? Will they get it pretty much? And will it be interesting for them to invest?
Good. Yeah. Oscar, from your perspective, other than the product and the evidence of scalability, is there anything else you guys are looking for in the early days?
Yeah, definitely. I mean, I could pull up a list, but I won't do that now. But like, let's say I look at a pitch deck, and generally when I review companies, it would be something like looking at a pitch deck or a summary, having a call with the founder, then having a call with the team to sort of decide over the company if it's the right thing for our investors. But generally, there are a couple of things. First off, the first impression, super important, right? This is not to be underestimated. I mean, it's one thing to have a good product and you're in a great market. Okay, great. That's the content part. But if you can't actually get the interest from the very beginning. It's very hard to secure, let's say, meetings with investors. So the stylistic aspects of a pitch deck is quite important. It's not the most important thing, obviously, of a business, but when it comes to fundraising, it's key. So generally, you should be able to showcase a whole business in 15 to 20 slides. And you shouldn't litter it with words. I've talked to entrepreneurs sometimes and they say, okay, but we have a very technical product. I can't explain this in 20 slides. Yes, you can. I've seen extremely complicated businesses explain it very well in 15 to 20 slides with just a few words per slide. So I would say first impression is very important. But when it comes to actually the content of the pitch deck, we want to see, first off, the product and market. Does it make sense? Is it solving an actual problem that is not now being solved, or is it doing it in a much better way than incumbent solutions? But after that, actually seeing that there is some market traction. Is there any validation that this business is, that this product, that there is a demand for this product? It can be pilots, it can be, well, paid pilots is great, but it can be unpaid pilots as well. It can be some early revenue. It can be that you have partnerships in place and so on. Then, of course, we come into other things like team. And when we look at the team, you can look at general areas like professional merits. If it's more R&D heavy, more deep tech, academic merits. Looking at founder experience. Do you have any previous exit? Either the founder, him or herself, or someone else in the team. Looking at advisors. And then, of course, looking at IP. The IP, just a note on that as a final thing. There are other things too, but these are some of the key things. If you look at the IP, you also need to show how it's used, right? Because sometimes I come across pitch decks that say, oh, we have IP, we have patents. It's like, well, that's all good. But how do these help you gain the sort of defensibility that you need?
Okay, that's good. Good. That's excellent. Ollie, could we maybe just picking up on something that Oscar said there? What would be your recommendations or your advice to companies when they're formulating their valuation? So, they've approached you, you're discussing investment and equity. What do companies need to do when they're working through the valuation of the company?
Okay, so it's a good question. There's probably a couple of key points on this, right? So my first key point is don't approach me with the valuation, because it's not really your job. If I'm totally honest, what we find is that if you were to approach us with the valuation, so the first thing to keep in mind is that PR is everywhere. And PR is reserved for the top performers, right? So just because you've seen some company in your space raise 10 million from Index at a 50 million pre-money with no revenue, doesn't mean I'm going to give you a 50 million pre-money, 10 million pound check when you've got no revenue. It's just not. PR is reserved for the outliers, right? That's the reality. So try to, whilst it's good to compare, make sure that your comparison is done across a wider market than TechCrunch, because actually it's really easy to get caught up in the PR storm and price yourself out of an investment. So the second part would be that I would always say to a company, when you've got a pitch deck or when you're putting a pitch deck together, don't put your valuation on there, because at best you're going to cap yourself. At worst, you're going to scare people away. And this is a conversation I had as recently as yesterday. A company approaching me, they're doing 3K of MRR, interesting business, looking to raise 2 million at a 15 million pre-money valuation. I already know that I'm not going to invest in that business, because actually I know that the difference between what I would consider to be suitable valuation and what they would consider to be suitable valuation, based on a market that I've looked at several times and an understanding of what they do, is probably going to be relatively far apart. And actually, if we're talking about a couple of million, if I'm willing to pay 13 and they're at 15, then maybe there's a discussion to be had. But when I know that I'm in a world where I'm looking to pay 5 or 6 and they're looking for 15, I know the disparity is probably too big for us to overcome. They've got to come down too far, or I've got to go up too far, and it's probably not going to happen. So that shuts the conversation down dead quite early. Like I said, at best, what you're going to do is you're going to cap yourself. You never really know what valuation someone's going to come up with. But what you do know is if you put your valuation on the deck, even if your valuation is reasonable, you're never going to get a valuation above that. You're never going to get an offer above that. And actually, you limit yourself in your ability to raise at higher valuations. I'm never going to offer you a valuation above what's on your deck because I know what your expectation is already. So when you go into that process, don't talk about, discuss, put in your deck valuations that you think may or may not think are achievable. Instead, go in with an idea of what you expect dilution to be. Dilution at seed rounds, you expect probably to be anywhere between 15 and 30%, depending on things like options pools and depending on size of ticket and stage of business. But the seed, the pre-seed, the seed, and the Series A are likely to be the most dilutive rounds of your company's life cycle. That's when you're going to dilute the most. Seed and Series A is probably going to be the two biggest rounds where you see the biggest dilution because they tend to be the biggest ticket for the earliest stage of business. It's that sort of equilibrium point. So you're probably going to see the biggest dilution in those areas. And so you need to expect dilution of anywhere between, like I said, anywhere between really 15 and 30%. General dilution is sort of between 20 and 25 probably. So as a result, what you need to do is you need to think about how much you're raising. You need to think what that level of dilution means in terms of pre-money valuation. If I want 20% of your business and I'm going to give you £2.5 million, or actually let's use easy numbers, right? If I want 20% of your business and I'm giving you £2 million, and I'm already setting a pre-money valuation, right? The pre-money valuation is £8 million, right? The maths works itself out. Like there's no way around it. Now, what I then need to think about is £8 million suitable for this stage of business and the business and where it's at the moment? If you're sitting there thinking, I don't know, £8 million seems like a tough ask, then maybe you're looking for a little bit too much money, or maybe you're expecting too little dilution, but you need to expect dilution within that range. So rather than go into a round and say, right, first things first, let's discuss valuation, which is not going to happen, have a level of expectation of dilution, know where your limits are, where your minimum limit and where your upper limit is, and then be prepared to have that discussion later. Because actually, that's where you're going to get the most. As long as you've got reasonable expectations, you should find yourself within a certain range. And that's how I would generally work it out. Because dilution is super important. It's one of the biggest factors that goes into early stage valuations.
Good. So it's not always about numbers, but it's not necessarily the numbers that the company are thinking or think are important. So
absolutely. Valuation, it tends to be the biggest thing. Valuation at my stage, like some of the valuations that I would give to some of our companies purely on paper, probably look a little bit ridiculous, if I'm being brutally honest. But the reality is that as a VC investor, I can't come in and give you a 2 million ticket, which is the sorts of tickets that I write, and take 50% of your business. It doesn't work like that. Like it's completely unfeasible, because then you'd struggle to raise future rounds of investment, which I believe you would need in order to become a unicorn company. So I have to take reasonable equity. And if I'm forced to write a ticket that's reasonably sized, 1.5 to 3 million, then actually I'm already pegged, right? Like I have to believe in the business in its current state to give it a suitable valuation, but it has to be within a range.
Okay. Yeah, no, that's fair enough. Anthony, have you got anything to add to that?
I think that was really well said. So just to maybe add a little bit of color to this in the way we kind of approach this, and we approach valuations a little bit different way, because we usually do not lead the rounds. There is usually an anchor investor in the round. Like, for example, all these VC would be in there leading the round. So the valuation question would be already covered and discussed with the VC, or for example, with a family office that is investing, that is anchoring the round. And we would usually take the same valuation for the round. Usually if it's a top-up mechanics, for example, if we kind of add in 30%, 40% of capital into the round, then we would take the valuation that's already pre-agreed with the lead investor and use that valuation. Of course, we would kind of also question that valuation and look at the similar companies in the similar area, so to say. If the valuation is in the range, so to say, where we want it to be, but we are not trying to approach it in the sense of, hey, we kind of want the best. There are some kind of approaches from some investors out there that want to really get kind of squeeze out the best valuations, so to say. Our approach is pretty much we want a realistic number there that is perceived not only by our team, our investment team, as a realistic one in terms of where the company is, where the company is going, but also is perceived as realistic by the retail investor and high net worth individuals that are kind of backing us up and that are actually investing in the companies.
Okay. Yeah, no, that sounds good. So I'm conscious of time, guys. Is it fair to say then that in the first instance, the really important thing is that a company gets a good match between the amount of money they're looking for, the exit strategy for the investor, and then alongside of that, it's much more about grabbing the attention in terms of the product or the need that the company's business proposals servicing, the market potential of the business, and the ability of that team to deliver. So grab the attention with those things, and then the numbers bit becomes important after that, Ollie. So it's don't come and ask us for 2 million at this dilution rate. Come and convince us that you've got a business that's worth investing in.
Yeah. Come and convince us that £2 million turns your company into a very significant business, right? Over a relatively short period of time.
Yeah.
Like I said, we only want to invest in businesses that are unicorns. I think the other thing to stress as well, and this is always a conversation that I have regarding valuations, is that people will say to me, well, you've given me a term sheet and you think that I can be £1 billion business. So why does it matter to you if you invest in a 6 million, an 8 million, or a 10 million pre-money valuation if you think that I'm going to be worth £1 billion? And it's a very good question, but also I think it comes with its own very good answer. And this is something important for everyone to know. My ability to raise money for my fund is not based on what you guys do in 5 to 7 years' time. It's based on what you do within the next 12 months, because I have to raise a fund every single year. So whilst I always think of the big picture, and the big picture is super important, actually, I'm thinking of the next 12 months as well. I want you guys to go and raise a Series A, and on paper, I want to be able to show our investors that at that Series A, on paper, you've raised at a significant enough valuation that we're seeing a really good uplift in the company. Otherwise, I'm going to struggle to raise money and no more money from me, right? So, and that becomes a problem, not just for me, but also for you as well as the company. So, it's very easy to get tied up in valuation. It's very easy to get tied up in what's a good valuation, what's a bad valuation. But that's just something to keep in mind as well. I'm thinking about what you're raising at Series A and how much you're raising and how much that's going to dilute me, not just what you're going to be in 5 to 7 years' time.
Okay, excellent, guys. Just conscious of the time, we maybe need to start wrapping up now. But just from each of you, have you got any one piece of advice, one sentence on how these companies should approach things if they want to have a successful round?
Yeah, I'll go first. Short pitch decks, well designed. I think it's really underestimated when I see a pitch deck that looks good, and it sounds quite petty, but when I see a pitch deck that looks good, I feel a significant amount more confidence in the founder.
I agree.
I feel like you've taken the time to put together a really good looking pitch deck. So actually, I know that your product's going to look good too. If your pitch deck looks old and tired and loads of words and A4 pages and all that jazz, then I'm like, I don't have a lot of confidence that you can build a really stellar product to be a world beater, a market winner.
That's fantastic, Ollie. Anything to add to that, Oscar?
Yeah, I also wanted to say that I think, Anthony, you touched on this before, that, it's a little bit different between like a VC and angels compared to crowdfunding, that in crowdfunding, it's more that it needs to be a little bit more exciting, maybe a little bit more relatable and so on. And what I wanted to say with this is, even if you're a B2B company and you're pitching to something like angels, and then you say, oh, but it's a stellar business model, I have a stellar product, but still you need to be able to make it fairly exciting. And it doesn't suffice with just being exciting as a founder, because we've had those founders in the past. They're great founders, they're very charismatic, but if you can't get to the call, which means you can't do the summary right and you can't do the pitch deck right, you'll never get to the call and you can never show off your skills. So you have to be exciting throughout. Yeah. I think that's quite important. And if you can't do it, then you need to eventually hire someone to do it for you, even if that's not optimal.
That's brilliant, Oscar. And last words over to you, Anthony. You got anything to add in?
Of course, I always have stuff to add, but it will be one thing here. And something we haven't talked about today is, well, as us as investors, we're selecting the startups, we're doing our due diligence. My piece of advice for the startups would be, do your homework, make sure you're doing your due diligence on every investor, and you are also very selective in who you're bringing on board, who is getting on your cap table. This is extremely important for the business, for the future. So think about this always as a very, very long-term relationship, and be also very selective and do your homework on every investor that you kind of are about to accept investment on, regardless of what stage of your business is.
That's fantastic advice, Anthony. Guys, can I just say thanks very much for taking part today. I hope the audience have enjoyed that. I think there's been a lot of really useful and incisive insight in there. And enjoy the rest of the day, guys.
Cheers,
thanks
guys.
Very much.
Thank you, Sandy.
Thanks very much.
Anthony.
Bye.
Bye-bye.
Bye, guys.